Let's walk through this together. Most investors chase high yields without thinking about whether those payouts can last, right? Today, we're going deep on 4 Singapore REITs that don't just pay, but have the structure to keep paying, and we'll unpack the factors that separate retirement-worthy income from dividend traps. If this sounds like the missing piece in a retirement plan, stick around. We'll talk about the current S-REIT backdrop, then break down Parkway Life, CapitaLand Ascendas REIT, Keppel DC, and Frasers Centrepoint Trust, one by one, and end with risks, portfolio strategy, and a simple roadmap. If you're new here, I've spent years breaking down investing in Singapore so you don't have to stress. So let's figure this out together. The article opens with a common pain point. The hunt for income often ends with cuts, tiny, safe yields, or complex strategies that look smart but underdeliver. The key idea is simple. REITs can be dependable if you pick the right ones and understand why they work. Rate cuts are finally tilting the field back in favor of REITs. Structural trends are also strong. So the goal today is to go beyond surface metrics and show how these 4 REITs held up through cycles and how they can help preserve wealth for retirement. What does the landscape look like right now? The sector enjoyed a strong third-quarter rally off late June 2025 levels, helped by expected Fed cuts that arrived in September. This matters because when borrowing costs fall and cash alternatives lose shine, REIT yields look better. T-bill yields have been slipping. Fixed deposit rates are soft, and the sector trades below long-term book value levels. That gives investors both income and a valuation cushion. But here's the nuance. This rising tide won't lift all boats equally. Quality selection matters more than ever. Imagine the comparison table in the article for a moment. It shows average REIT yields around 6%, price to book under 1.0, and about a 4% yield premium over government bonds. Translation, income is compelling, and you're paying less than book for many names. But why does that matter for you and me? Because retirement income needs both durability and margin of safety. Before we jump into each REIT, there's a quick side-by-side snapshot that frames the story. Think of Parkway Life as healthcare, S-REIT as industrial scale, Keppel DC as data center growth, and FCT as suburban retail resilience. The table highlights AUM, revenue and DPU growth, and occupancy. Keppel DC leads on growth. FCT stands out with near full occupancy. S-REIT shows mixed top-line momentum, but with hefty scale. Parkway Life shows steady defensive growth. So, first up, Parkway Life REIT, the healthcare fortress. Let's make this simple. Aging populations and healthcare demand are long-term trends. Parkway Life owns 75 properties across Singapore, Japan, France, and Malaysia, with $2.46 billion in assets. It also has a strong link to IHH Healthcare, which gives it credibility and a growth pipeline. In the first half of 2025, revenue rose 8.1%, NPI rose 8.0%, and DPU edged up despite more units. The kicker? A tax exemption on foreign-sourced income from 7 French assets adds real, recurring savings. They run a conservative balance sheet with 35.4% gearing and low debt costs, which means they can buy well in a falling rate world. So what does that mean for us? It's a core, sleep well at night income anchor. The call here is a buy, with a 20-25% portfolio allocation for retirement income stability. Next, CapitaLand Ascendas REIT, the diversified powerhouse. This is Singapore's oldest and biggest industrial REIT, with 229 properties and $16.8 billion AUM. Scale gives bargaining power and resilience. H1 2025 showed slight declines in revenue and NPI. That sounds bad, but peel the layers. Singapore renewal leases had strong rental reversions around the high single digits, so the local engine is working. Headwinds are from currency and higher financing costs, which could ease as rates come down. The strategy is clear. Recycle capital, upgrade assets, and redevelop where the returns make sense, including a major science park project and 6 active projects nearing $500 million. Analysts still see upside. So, what's the move? The call here is a hold, but with a big role in the core. Suggested 25-30% allocation for long-term total return, with the view that 3 to 5 years is the real runway. Now, this is where it gets interesting. Keppel DC REIT, the AI revolution beneficiary. If Parkway Life is the defensive anchor, Keppel DC is the growth engine. It owns 24 data centers across 10 countries. In H1 2025, revenue grew 34.4% and NPI 37.8%. DPU jumped 12.8%. The driver? Tight supply, high demand, and big rental reversions, around 51% this half. As AI workloads surge, data center demand isn't just a trend, it's a supercycle. Management keeps pruning and adding with divestments like Basis Bay and a funnel of third-party deals across Japan, South Korea, and Europe. The yield may look lower than some REITs, but the growth rate and quality of cash flows justify it. For us, that means a structural growth slot in the portfolio. The call is a buy, with 15 to 20% allocation if you want secular upside. That brings us to Frasers Centrepoint Trust, the retail resilience story. Think heartland malls, daily need tenants, and high tenant stickiness. FCT's 9 suburban malls drive stable cash flows. H1 2025 revenue and NPI rose in the 7% range, DPU ticked up, and occupancy is a near perfect 99.9%. Rental reversions improved over last year, showing strong landlord pricing power. They're adding value with asset enhancements like Hugang Mall aiming at a 7% ROI and expanding strategically with assets like North Point City South Wing. For a retirement plan, this is defensive growth that compounds quietly. The call is a buy with a 20 to 25% allocation. Quick pause for the numbers, people. The growth and efficiency table in the article stacks these 4 side by side. Keppel DC tops revenue and DPU growth. CLA, even with a revenue dip, still shows strong revenue per AUM efficiency thanks to scale. Parkway Life is steady and efficient. FCT is consistent with top-tier occupancy. The message is balance. Blend durable income with growth drivers. Now let's talk risks and how to think about them. Interest rate sensitivity is the big one. Rate cuts help, but paths aren't always smooth. Check debt maturity ladders, hedge ratios, and fixed versus floating mix. Sector risks vary. Healthcare faces policy and operator risks. Industrial hinges on economic cycles. Data centers carry tech shifts and hyperscale tenant concentration. Retail competes with e-commerce and consumer spending swings. The table in the article simplifies these risks by REIT, so you can match them against your goals. But here's what I look for. Managers who actively hedge, stagger maturities, and recycle assets with discipline. This is where good REITs separate from the rest. Strategy time. The article suggests a core satellite approach that fits most investor profiles here. Core at 60 to 70%, with CLAR and FCT for stability and diversification. Satellite at 30-40%, with Parkway Life and Keppel DC for healthcare and AI growth themes. Imagine the table for a second. It shows a clean split. The core gives you ballast. The satellites add upside. This is not about chasing yield. It's about building a durable income engine with selective growth. And if CPF/SRS is in the picture, note these REITs qualify under those schemes. Higher SRS allocations can make sense for deferring tax. One more tip. Most of these REITs have DRP options. Reinvesting distributions is a quiet but powerful compounding lever. By the way, if you want all the reference tables, the risk checklist, and the written version, everything's on Substack. The link's just below. The implementation roadmap in the article breaks it into 3 simple phases over a year. Phase 1, months 1 to 3, build the foundation, equal weight, the 4 to get exposure. Phase 2, months 4 to 6, optimize, tilt toward the sectors and names with the strongest momentum and fundamentals. Phase 3, months 7 to 12, harvest, use tax loss harvesting where it makes sense, but keep the strategic allocations intact. This sounds simple, but it keeps you honest. You build, you adapt, you protect. Here's my honest take. In my experience, what matters most is owning quality managers with clear balance sheet discipline and a track record of doing the boring stuff well. Renewals, AEIs, recycling, hedging. If I could give you one thing to remember, it'd be this. Don't chase the highest yield. Chase the most sustainable DPU with the best risk controls. That's how retirement income survives cycles. Wrap-up time. If you're planning your next move, here's what I'd keep in mind. The backdrop is turning supportive, but selection is the edge. Blend Claire and FCD for stability, add Parkway Life and Keppel DC for long-term upside, and stick to a simple 3-phase plan. What are you looking at this month? Drop a comment. I read all of them, and I learned from the community too. If you want the deep dive models, early access notes, and the full premium write-ups, consider joining as a paid member on Substack. It supports the channel and gets you everything first.